The Federal Reserve has now cut interest rates to zero and is printing hundreds of billions of dollars in a new round of quantitative easing to try and support markets. In this video, we'll be going over what the Federal Reserve's actions could potentially mean for the stock market going forward, as well as discuss its impact to other asset classes. So for some further clarification, on Sunday, the Federal Reserve lowered interest rates from 1% down to 0%, and they decided to lower this in response to the potential economic slowdown that appears likely in the future. In addition to cutting rates to zero, they're now printing over $700 billion to purchase $500 billion of Treasury securities and $200 billion of mortgage-backed securities. This is an attempt to try and stabilize the markets. However, in my view, making this announcement on a Sunday evening in an emergency Fed meeting doesn't instill a lot of confidence. Not only that, earlier today on Monday afternoon, they announced an additional $500 billion that they'll be injecting into the market. So effectively, over the past 24 hours, the Fed has announced new plans to print $1.2 trillion into the market. Now, all this liquidity will go into the bond market, but remember, when the Federal Reserve is doing quantitative easing, that's just another name for money printing. When the Federal Reserve buys a bond, they're creating new money to purchase that bond and put it on their balance sheet. By doing this, the previous holder of that bond now has new money and new cash, which may eventually make its way into other asset classes. Now, so far, the markets haven't responded particularly well to this, and it shouldn't come as too much of a surprise. The last time the Fed did an emergency rate cut was prior to the Great Recession. And as we'll see in a bit, taking a look at the most recent economic data, it looks like a recession is the most probable outcome at this point. To give you a rough sense of the magnitude of these market declines since the peak on February 21st, I have 6 different hypothetical portfolios that track the returns since this period. Now, the first portfolio is the US stock market, and this is 100% invested in an index fund tracking the total US stock market. The next is a traditional 60-40 portfolio, 60% invested in a US equity index fund and 40% invested in a total bond market index fund. The next is a portfolio I particularly like, and that is the Golden Butterfly portfolio, which is split evenly into 5 sections: 1, a total stock market index; 2, a small cap value index; 3, a short-term bond index; 4, a long-term bond index; and the 5th section into gold. The fourth portfolio is a 90-10 portfolio I call the Buffett estate plan because it's how he suggested his executors invest his estate following his passing. In this case, it's 90% invested in the S&P 500 and 10% invested in short-term government bonds. For comparison, Buffett's current net worth is almost entirely invested in Berkshire Hathaway stock, so I have a separate portfolio for that here. And then I have a stock basket evenly invested in the 5 largest technology stocks in the US: Facebook, Apple, Amazon, Microsoft, and Alphabet or Google. So the whole idea of this is to give a general sense of how far the market has declined in this time, as well as to provide a slight comparison when looking at asset allocation. Interestingly enough, the portfolio that has done the worst has actually been just the index. And that's kind of interesting because most of the time you think that most investors can't beat the index, but in this case, if you had any other portfolio, you likely did. Now, this is likely for a couple reasons. One is that when you're investing in 100% in an index, you have 100% stocks or equity, which is one of the highest risk portfolio asset allocations you can have. In addition to this, index funds typically outperform most active investors during bull markets, but during bear markets, active investors tend to do better than the index, primarily because they can act more defensively and avoid some stocks that may have been previously overvalued. So overall, understand that most investors are likely experiencing a significant amount of volatility within their own portfolios unless you have an asset allocation that differs quite significantly from one of the portfolios seen here. Taking a look at the CAPE ratio or Shiller PE ratio, the market drop and reversion to more historical levels of valuation shouldn't come as that much of a surprise. Previously, the markets were at the 3rd highest valuation point at any time during the last 150 years. The other 2 highest points of valuation being the dot-com bubble of 2000 as well as the stock bubble of the 1920s. When your closest historical comparisons from a valuation standpoint were both known to be historical bubbles, that probably should raise some red flags. Now, does the Federal Reserve's actions of cutting interest rates and now doing quantitative easing change the story here? Now, if we look back over the past 2 recessions and the valuation change over that time, during the dot-com bubble, the Federal Reserve did decrease rates, but that isn't going to keep stock valuations elevated, and those will come back down. Similarly, during the financial crisis, we saw rates cut eventually down to 0, and significant money printing by the Federal Reserve in the form of quantitative easing over the following decade, which can be seen by the growth of the Federal Reserve's balance sheet. Notice that the Fed announced a new round of quantitative easing of $1.2 trillion just in the last 24 hours. The Federal Reserve has actually already started printing money back in September of 2019, which could have been viewed as a warning sign for investors. Another valuation metric is the Buffett Indicator, which is simply the ratio of the total stock market capitalization over the gross domestic product, or GDP. Based on this metric, at the end of 2019, we were at one of the highest points over the last 30 years, with the other one being the dot-com bubble of 2000. Now, the recent market decline has brought this ratio down, but it's still above historical averages. So what does this mean for stocks? Is this a net positive? Does it have really no impact, or could it actually even make things worse? As we've seen, valuations were already high, and appears based on all data that we're looking to see an economic slowdown. So if valuations are high and earnings aren't going to be growing, then it's natural that stocks and those valuations start to come down. Cutting rates to zero, as we saw during the financial crisis, doesn't change that in the short term. However, cutting rates does have a significant impact in the bond market. This graph shows the U.S. Treasury yield curve, which is the yield based on different durations of Treasury notes, bonds, and bills available and issued by the U.S. government. So just 1 year ago, the 30-year Treasury bond was yielding 3%, and 3-month Treasury bills were yielding 2.5%. Fast forward to today, though, and U.S. rates are now significantly lower, the 30-year Treasury yielding just 1.3%, the 10-year significantly under 1% yield at 0.7%, and Treasury bills yielding now almost zero, currently at 0.3% for the 3-month Treasury bill. These lower bond yields are a function of expected lower future growth, as well as central bank interventions through purchases from the Federal Reserve. Now, the Federal Reserve can continue to print money to purchase these bonds and keep yields artificially low, but in my view, that just adds a lot of tail-end risk if the Federal Reserve loses control of the bond market. And based on the Federal Reserve's knee-jerk reactions to the stock market, I'm not particularly confident in central banks. So the question I have for investors in these long-term bonds is, if you know the Federal Reserve is going to continue printing money, which will make the dollar worth less and less in the future through inflation, then why would I lock in such a low yield now that I am almost guaranteed to lose purchasing power over that 30-year time period? While I may receive 1.3% in interest per year, the Federal Reserve has already publicly stated that they're trying to depreciate the currency by 2% per year. 1.3 minus 2 is negative 0.7, so effectively I'm losing almost 1% per year in real purchasing power by locking in these artificially low rates. Now, one of the few spots you used to be able to park some cash without having to take on such long duration risk were in money market funds or short-term bank deposits, where you could get a reasonable yield without taking on significant interest rate risk. However, now that the Federal Reserve has cut those rates to zero, they're effectively punishing savers by taking away any interest you can earn on your cash deposits. I recently got a notification email from Ally regarding my savings account that the rate has been decreased from 1.6 to 1.5% per year. Now, over the coming months, I'm expecting that this rate will effectively drop close to zero as a direct result of the Federal Reserve's actions. Unfortunately, if you look at the past history of the effective federal funds rate and its changes over time, it doesn't paint a very optimistic picture. Almost every time there has been a decrease in the federal funds rate, and every time there's been an emergency decrease in the federal funds rate, it has preceded a recession. And the difficult thing is, once rates are at zero, it's very hard to raise them again. It took over 6 years since the financial crisis for the Federal Reserve to raise interest rates just once. And unfortunately, we only lasted 3 years before the Federal Reserve started decreasing rates again, and 4 years before now again we're back at zero. Another recession indicator is looking at the sales of heavyweight trucks over time. And as you'll notice, most periods where we've seen a decrease in the rate of heavy truck sales, we've seen a recession at some point thereafter. It's likely indicative of a decrease in the amount of transported goods, or a proxy for the general economy. Interesting that this decline started happening at around September 2019, which coincided with the time the Federal Reserve started printing money again and increasing their balance sheet. So going back to stocks and taking sort of a long-term step back from all of this, I think it's important to keep in mind that while the Federal Reserve is going to try and take actions to stabilize this market volatility, ultimately they won't be able to stop a recession that's been in the works for quite some time. In addition to this, with the Federal Reserve keeping rates so low and issuing many rounds of quantitative easing following the financial crisis, they've helped push up market valuations over time, which can make periods like this when we finally revert to a more normal market valuation much more emotionally taxing because we see very large percentage declines and swings in the market. Now, looking at the year-to-date performance of the components of the S&P 500, you can see that some stocks and some sectors have been hit harder than others. Some sectors that particularly stand out are financials, energy, as well as travel and hospitality related stocks. I think these sectors will likely be the hardest hit during this upcoming economic slowdown and market turmoil. Financials will get hit both due to overall lower lending growth as well as now lower interest margins given that the Fed has cut rates. Energy will likely see declines as not only is there a demand drop off because of slower growth, but the oil price and the price of other energy goes down as well. In addition to this, the energy sector is also highly capital intensive, is oftentimes very levered, having a fair amount of debt, which could lead to liquidity issues, potentially bankruptcy, or at minimum, a dividend cut, which is one thing we've already seen with Occidental Petroleum, down over 65% year to date. Hospitality and other travel-related stocks are also likely to be hit hard during this time. This includes cruise lines and resorts, hotel and lodging, as well as the major airlines. In addition to this, any firms that have an unhealthy balance sheet or relatively high leverage, meaning that they have a fair amount of debt, if those companies have any issue with cash flow going forward, they're going to have much less financial flexibility as they need to meet those interest payments on those debts. Given this, companies with a healthier balance sheet, more cash, and less debt will likely outperform those with more leveraged balance sheets. Just something to keep in mind as you're looking for opportunities potentially later down the road. Overall, it's going to be a very interesting period in the markets going forward. I think it'll likely get worse before it gets better. I wanted to provide just some of my thoughts on the matter, but I'm interested in hearing what you think as well. Let me know in the comments below what's your reaction to all of this. I have more content coming this week, so until then, thank you so much for watching. My name's Michael, and I will see you in the next video.